Anytime someone says, I'm moving to cash, I'm getting out, the three questions that always come up is, okay, A, what's your specific set of indicators that's going to allow you to get in? B, if you wait for the dust to clear, you're too late. The market's already sussed that out and ran up. And then lastly, and perhaps most importantly, do you have the temperament, the discipline, the ability to get back in when every instinct in your body is telling you, run away? We evolved as social cooperative primates. And when everybody else in the troop of chimpanzees in the trees are running away, to stay and say, no, I don't think that's a leopard. I want to stay here because everything is there. Bananas here. Every piece of your wetware, your instinct, your evolutionary adaptive subroutines is to join the group and run away.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this podcast and YouTube series, Real Estate Market Watch, Current Events Through a Real Estate Lens. My guest today is Barry Ritholtz, who is chairman and CIO of Ritholtz Wealth Management, a multi-billion-dollar RIA firm based out of New York. And I contacted Barry because I really did want this perspective of what's going on in the market from a wealth management angle. So our conversation actually is very broad, and Barry speaks to a large range of extremely interesting people. On his podcast that is produced by Bloomberg, it's called Masters in Business. And so he has some very interesting insights from conversations that he's had through his podcast. And we talk about history as an indicator of where we are today and what's going on today. I was interested in understanding his views on exiting the market in preparation for some kind of downturn, what his views were on the likelihood of a downturn, what the impact of tariffs are, the impact of de-dollarization, etc. And we talked about all of these topics, and you'll hear from Barry his perspective as a wealth manager, particularly with a focus on the equity markets, but we do also lean into real estate as well. If you've not already done so, please go to GowerCrowd.com and subscribe to my newsletter, which covers these conversations that I'm having in more detail, summarizing in written form the highlights of our conversations. And if you've got a moment, go ahead and connect with me on LinkedIn as well. I've been writing a lot on LinkedIn and actually really enjoying that process. So GowerCrowd.com to subscribe to the newsletter, and LinkedIn if you get a chance to connect with me there. All right, let's move on. It's quite a long conversation with Barry. His podcasts typically run 2 hours. We don't go quite that long, but it's definitely worth tuning in all the way to the end. Barry's a very interesting and insightful fellow. Let's hear from him right now. Here he is. Barry, huge pleasure to meet you. I've been reading your posts on LinkedIn a lot and following you, and you are, well, from what you were telling me a few moments ago, it sounds like you're a professional podcaster. But why don't you tell me a little bit about your background and how you got to Ritholtz Wealth Management? So you've done some interesting things, and continue to do some interesting things.
Sure. So none of this was ever part of my plan. It just kind of happened. I started out in the finance industry as a trader. And as you could see from my office, I got like piles of books and junk lined up, and I'm super disorganized. And to compensate for that, I would put together a list of things each day. Here are the earnings calls that are coming out. Here's the economic data that's expected to come out. Here's the consensus. Here's the range. And I learned on the trading desk, I didn't want somebody's voice in my head when I'm making risk reward decisions. So I put together a list of these are the 10 most interesting looking articles that I'm going to read on the train on the way home. I don't want to read beforehand. And I would literally tape it up to my monitor back in the day when monitors were big CRTs, not flat screens. And so that started getting Xeroxed and shared around the office. And then that became an email list. And then that became a post on Yahoo GeoCities. I want to say like 98, something like that. And eventually I moved the GeoCities post to TypePad, my first blog. I named The Big Picture after a book from William Goldman. In 2008, that became a WordPress blog. I wrote my first book, Bailout Nation, on the blog with the help of hundreds of readers back in the golden age of blogs where comments were useful, not just spam and trolls. That led to the Washington Post column. That led to Bailout Nation and the Washington Post column, which eventually led to Bloomberg. All of this media stuff has kind of been my side hustle. My actual job was I was market strategist for Maxim Group, was a big shop that was a roll up of Herzog and Ernst and a bunch of other companies. Ran a software division of a quantitative shop for a few years, and more or less through a combination of hard work, skill, smarts, and a whole lot of luck, got the top and bottom of the financial crisis more or less right. And so that led to people just throwing money at us, throwing money at me. And so me and my partners launched Ritholtz Wealth Management in 2013. That was, $5.5–6 billion ago.
Really? Oh my goodness, that's a lot of AUM you have.
You know what? I have this conversation with family members, like at holiday dinners and stuff. And it's like, no, that's walking around change. That's a few $1 billion is 0.00001% market share. Not only are there firms with 50 and $100 billion,
Sure.
There's something like 20 firms in the US with more than $1 trillion, 30 something firms
really
globally with more than $1 trillion. Vanguard is 10 trillion. BlackRock is coming up on 12 trillion. I think these guys spend more money on pencils and toilet paper than our total AUM. That's how insignificant, but it sounds like a big number, but in the scheme of things,
sure,
we're small potatoes.
You're very modest.
It's just math. It's really true.
Okay, so let me ask you this then. So you did say we got the top and bottom of the financial crisis right. Tell me what you mean by that exactly, because you've also talked about looking at prior crises to read what's coming on now. So just tell me about your experience of the global financial crisis, and let's dovetail into history.
Sure. So I am neither an MBA nor a CFA. My background is started out applied mathematics and physics in college. By the time I'm a senior, I'm like, this isn't for me. I switch to political science and philosophy. Go to law school, do really well. Me and some friends all graduate cum laude, passed the New York, New Jersey bar first time out. Loved law school, discovered I hated the practice of law. Just not a surprise for a guy whose blog is The Big Picture. Hey, how do you feel about tedious minutia and agonizing detail? Not for me. So, because my mom was real estate and because I didn't go through the usual MBA process, I looked at data a little differently. And I was very aware that all models are wrong, but some are useful, to quote the British statistician George E. Box. And so that you can't get too upset about the typical data series. You can't overly focus on it. On the trading desk, I found myself fascinated by why different people were either making money or losing money each week. They're all doing more or less the same thing. And in the mid 90s, like I remember the Netscape IPO. Hey, newbie, no trading the Netscape IPO today. That sent me down the rabbit hole of behavioral finance before all the cool kids discovered it. And so Thomas Gilovich, probably early 90s book, How We Know It Isn't So. And then that led to Schiller and Thaler, and that led to Kahneman and Tversky, and that led to David Dunning and just the whole, and Meyer Statman. And so
Well, hang on. Who are all those people? Wait a second.
So those are
what
all.
Is that a field of thought somehow?
So Kahneman and Tversky are the key drivers of the entire. Two psychologists from Israel. Okay. Tversky died previous to 2001 when Kahneman won the Nobel Prize in Economics for their work. Pretty much everybody else I mentioned in that list. Dick Thaler at University of Chicago won the Nobel Prize for his work driving behavioral finance. Bob Shiller at Yale, another Nobel laureate. All, by the way, guests on the podcast over the past few years. My dirty little podcast secret is that I just interview people I want to sit and have a conversation with. Yeah. If nobody else listened, I honestly wait. Bob Shiller and Dick Thaler are going to give me 2 hours. Who cares who's listening?
This is exactly my approach to podcasting as well. But
I think it's the right approach. So to answer your question with this ridiculous digression, because my mom was a real estate agent, because I was paying attention to how the economic cycle in its fullness developed and unspooled. Hey, normal economic cycles are the economy does better, more people get hired, more people get raises, then they go out and buy a house. And then that house is filled with durable goods. And, that's the usual cycle. But what I noticed post 9/11, post.com implosion is, wait, we've seen wages lag for 30 plus years. We've seen the upper end of the economic strata do really well, but not the lower end. The demand for product with a high yield was driving all the securitized product. People were doing all these cash out refis. I'll never forget the first house we owned. We refinanced our mortgage, and I'm not exaggerating. It was a little house. I think we paid $260 on Long Island for it. We did a cash out refi. The guy screeches into the driveway, throws the door open, leaves the engine running, comes in waving like a stack of papers. Sign here, initial, tears off the check. Here's 30 grand. I apologize. I have a closing down the road, jumped in his car and ran out. I want to say that was like 2004. And I remember looking at my wife and saying, strange things are afoot at the Circle K. This is a terrible, terrible thing we just experienced. If this is being reproduced over and over again, I got to dive deep into what's going on in mortgages, HELOCs. And I wrote a couple of commentaries, the backwards real estate driven economy, and then the rising risk of derivative problems. And I eventually took a Reinhardt and Rogoff research paper where they found leverage-based financial crises across 5 areas. I think it was Helsinki, Japan, Mexico, the Depression. I always forget.
This time is different thing.
Right. Well, that eventually became that book, 800 Years of Financial Folly. But 32% is the average real estate crash. Kind of reverse engineered the Dow and said, what happens? We're at about 14,000. What happens if real estate falls 32%? And I ended up with a number like 6,800, which was my entry in the Business Week annual forecasting nonsense, which I didn't want to do, but kind of got talked into. Pitched them on, let's run a counter programming on how silly all these forecasts are. The editor says, it's a double issue. We sell a shit ton of ads. Do you want to participate or not? So for about a year, I was an idiot. 6,800, the market's going higher. It peaked in 2007. By January, February, March of 2008, suddenly, that guy Ritholtz, he doesn't look like such an idiot anymore.
Yep.
Told a buddy, don't let me double down if we get anywhere near 7,000. You've seen these guys, 10,000, 5,000, 2,500. The reason I mentioned this was so much dumb luck was A, my mom was a real estate agent. Otherwise, I wouldn't have been looking at this. And B, my wife is a teacher. We go on vacation based on the school schedule that I have nothing to do with. The vacation in 2009 in March just happened to coincide with the dates when we're on a cruise somewhere. The Dow fell through 6,800.
Right.
Came back from vacation. There's a voicemail. This is pre-iPhone days, like early iPhone days. So there's a voicemail on our machine at home. Hey, Ritholtz, we just crossed 6,800. You told me to kick your ass when we get here. Here's your phone call. So I write up, cover your shorts and go long here. Everything I look at is as deeply oversold as it ever gets. That goes out Sunday night. Immediate response, Henry Blodgett. Hey, come on TV tomorrow. Let's talk about this. So I want to say that was like a Monday, and then it broadcast that afternoon or the next morning, and that was the bottom.
Okay,
I could have come home a month earlier, a month later. It would have been the same exact thing. So
you were vindicated, but for a while, did you feel that you were a lonely voice talking about the downturn? How did that feel? Because
I'll tell you a very funny story. Peter Bookvar, funny to me anyway. Peter Bookvar, who now runs his own research shop, but used to be at a bigger firm. The two of us had done CNBC at the Madison Avenue office, and my office was like 44th between Madison and 5th, and his office was a block or two away. And we both had been on CNBC like late fall 07, and the anchors literally laughed at us on the air. Like, it was unthinkable. Seriously? And I don't do forecasts. I said the whole Dow 6800 thing was, hey, there are a whole lot of embedded risks and derivatives in these securitized products and all these subprime products. I don't think the average investor is aware of how much risk is out there. They just think that, hey, 0% rates, we're going up forever. Peter and I walked back to our offices after the CNBC hit and kind of were like astonished that we were laughed at live on TV. And I said, that kind of encourages me, because it's one thing for someone to say, you raise some valid points, but I think I've had this argument with people who say passive is going to cause a crash in the market. I've been having this argument with people for 20 years. And I'm like, well, I understand your point, but I just don't see passive having that sort of negative impact.
What do you mean passive? Well, what's passive?
Broad indexing, the move away from active mutual funds towards broad indexes, the S&P 500 or the VTI, the Vanguard Total Market, or BlackRock, or now 51% of mutual funds and ETFs are managed in a broad index style rather than an active. So as we're walking back to our offices, I'm like, hey, it's one thing if they would say, you raise some valid points, I disagree with you, but that's not what we got. What we got was, that's hilarious. It's unthinkable that there's any risk in the market. Buy the fucking dip. Like, that was literally the whole attitude. It's like, okay, so you guys, it's not that you disagree with me. You simply cannot imagine that there's any risk embedded in a market, which, by the way, is just about doubled off of the 0203 lows, driven by low rates, not driven by the normal economic gains. And so it encouraged me to be a lonely voice. It was not discouraging.
Are you a lonely voice today? What are your views on what's going on today?
So sometimes I feel like I'm a lonely voice.
So why? What are you saying that sounds like that is getting those chuckles and ripples of derision from,
I'll give you two recent examples. So, and a lot of this has to do with people's information, diet, what they consume,
I see. Right. Not what they have for breakfast diet.
So there's a lot of noise in February and March after the new administration was sworn in. And a lot of Sturm and Drang, and then, tariffs are coming. Here comes Liberation Day. And I wrote a piece where I said, tune out the noise. Listen, if you don't need your money for 5, 10, 20 years, what happens in 2025 isn't relevant to you. This administration clearly is very noisy. There are a lot of new policies, a lot of policy reversals. It's going to be up and down, up and down. Hold aside the previous commentary. Hey, back-to-back 25% years, such a small data set, we had to look at back-to-back 20% years. You tend to end up with, lower your return expectations following 6 years of gains in 24 months. And I got a lot of pushback. How could you tell people to tune out the noise? Crazy stuff is happening. Democracy under assault. I go, true, but is this worse than the pandemic? Is this worse than the great financial crisis? The dot-com implosion and 9/11? Is this worse than the 87 crash? I don't think so. And, that was March. We had the sell-off in April. We're now back above levels where that tune out the noise piece came out. I had to change the headline from tune out to manage the noise. So it feels like that's sort of a lonely position. And then this week I wrote, never take candy from strangers. That your mom was right? Growing up as I did in the 70s and 80s, we were latchkey kids. It wasn't you didn't have helicopter parents and just all these after school activities. You'd come home, get something to eat, go to the schoolyard, play basketball or stickball or whatever. And my parents gave me, and every other kid of my generation got these 3 rules. And the rules were, let us know where you're going to be after school, be home at 6:00 for dinner, and never take candy from strangers. Those were the 3 rules. And the iPhone has made the first 2 rules. They've replaced it because parents know exactly where their kids are, literally to within a foot or two. Hey, I'm going to be late for dinner. You could text. But the same rule, don't take candy from strangers, applies especially in today's environment of 24/7 financial news, TV, radio, Substacks, Beehive, blogs, and most importantly, social media. So if you wouldn't take a candy from a stranger, why would you listen to somebody who doesn't know who you are, what your tax bracket is, what your income is, what your zip code is, what your financial goals are? They're all selling a product. And I put this in a blog post and I said, hey, let me tell you what I'm selling. I want you to read my blog post and I want you to buy my new book, How Not to Invest. It's not that all these embedded sales are so nefarious. It's the opposite. It's that they've become so ubiquitous, we don't even realize these people are going on TV, hosting Substacks, hosting a podcast because somebody is selling a product somewhere. Mm-hmm. Don't be like I was early in my career where I believed everything I saw and heard. I was a sucker for every smooth talking salesman. Be a little less naive, be a little less gullible. And if you're going to pay attention to somebody, to their Substack, to their podcast, you should know a little bit about who they are. What's their process? Is it rational? I get these pitches all the time for allow us to use your horoscope to pick stocks. Hard pass. Is their process rational? Do they have like a reasonable temperament, or every time there's a 7% pullback, they're running around with their hair on fire? Have they lived through a few cycles? Have they been more right than wrong? Hey, once you figure out who these people are, put together an A-team of your favorite people who have demonstrated they're worthy of your time and attention. The other, Ted Sturgeon was a science fiction writer in the 1950s and 60s. People used to ask him, how come so much science fiction is bad? And he would say, science fiction, 90% of everything is crap. And you know what? Sturgeon's law applies to everything in finance. Most mutual funds are not good. Most alternatives are not worth your time. The vast majority of the noise you see everywhere probably could be safely ignored. Even stocks, the vast majority of stocks don't contribute to your portfolio. And so we need to be a little more thoughtful and a little more selective.
Barry, you've talked about kind of higher level macro perspective. You've talked about dollar weakness, and I'm not sure if you've used the term de-dollarization, but there's clearly an erosion of trust in the US from overseas. A lot of our international investors looking at what's happening to institutions in terms of the tariffs, to law and order in America. What is the impact of that, in your view, to the long-term perspective, to the long term, actually?
So, a big part of what I've been writing and what I wrote in the book is nobody knows anything, to channel William Goldman, two-time Oscar-winning screenwriter, All the President's Men, Butch Cassidy and Sundance Kid, famously wrote the screenplay to The Princess Bride, and he was talking about Hollywood. Everybody passed on Star Wars. Everybody passed on Raiders of the Lost Ark. It was just one era after another. And when we pretend to know what's going to happen, we tend to make policy mistakes. So I try not to give binary predictions. I try and say, let's war game this and lay out a range of scenarios from best case to worst case scenario. Right. And my best case scenario is kind of the taco trade. All right, all this.
Explain what that is to those that don't know what the taco.
That's a meme from the Financial Times that spread like wildfire through trading desks everywhere. Trump always chickens out.
Right.
Here's a tariff. No, the tariff's off. Mexico tariff gone. Canada tariff gone. 135% tariff on China. Just kidding. No, we're going to have this tariff on Europe, JK, right. And just on and on. So I think the market has kind of become inured. It happened in his first term also. The market has kind of got tired of this, but that's the best case scenario is I'm fond of saying if you really want to know if things are going to be good, just ask yourself, who was the last person to whisper in the president's ear? If it was Scott Bessent, a Wall Street guy, we're going to be great. If it was Peter Navarro, a fourth-tier economist at a third-tier school that was found by Jared Kushner, because the president in his first term said, find me an economist who supports tariffs. And the only idiot who agreed that Smoot-Hawley was a good thing in 1930s was Peter Navarro. So he's our trade advisor. If he's the last guy to whisper in the ear, well, that's a bad thing for markets and for the economy. So that's the good case, medium case. The worst case scenario, I'm going to outsource that to Ben Hunt at Epsilon Theory. I try and make him a little happier. He try and makes me a little more dour. So we kind of swap ideas all the time. He had a post immediately after April 2nd called The End of Pax Americana that talked about all of the amazing benefits that the U.S. has enjoyed since the end of World War II, political, economic, military leadership, the wealthiest country in the world, our exorbitant privilege of the dollar as the reserve currency.
Right.
And he says, oh, that's going to hell, courtesy of Liberation Day. Now, he's walked that back a little since we've seen Taco. But basically, I don't know what the future holds. Here's a dirty little secret. Neither does anybody else. So that's why I always want to say best, there's a million gradations, but here's your best case scenario.
You've not described worst case scenario. What is worst case scenario?
So the worst case scenario is the end of the dollar as the global reserve currency, a repatriation of foreign investments in the U.S., rates spiking, inability to finance our debt, economic recession, and then a depression, all a self-inflicted, unforced error.
Right.
And I spend a lot of time in the book talking about the best thing investors can do is, I know you think you're going to find the next NVIDIA or Microsoft. The odds are you're not. So rather than try and hit home runs, how about just make fewer strikeouts? Just make less unforced errors. And I wish not only that investors would do that, I'm wishing that the administration would perhaps do fewer unforced errors as well.
Right. So from an investing perspective, so the worst case scenario, and I know you've said you don't make predictions, and that's fine. The hardest thing to make predictions about, as they say, of course, is the future. Right. But from a real estate perspective, and when you do look back at history, and you've alluded to this, and you talked about the GFC, there are periods in time when the market does, and again, my focus is very heavily on commercial real estate. When the market does tank, right? I mean, it really crashes. And then it takes years and years and years to recover. And there's a period of wealth transfer where people lose their assets. And then there's a slow buildup. And those that come back in later actually do exceptionally well. But they have to go into the downturn with cash flow and very low debt. So it's a different approach than when you're coming out of a downturn. If you're if your goal is not to lose money, and you think that there is, I mean, the very fact that you talk about a worst case scenario as being another depression right now
Yeah.
is telling. Wouldn't it make sense to go to cash now, reduce debt, and wait and see? Like, what's the downsides? For example, my view, if I was going to go out with my lonely voice,
Right.
I think that we're going to see very significant market correction before the midterms. So I mean, it's got a date on it, right? It's going to happen before the midterms. So there's a limited period of time, and the best option right now is to go to cash, wait, watch, and then come back in. As far as I'm concerned, the downside to that, maybe I don't I don't grab the upside for the next 12 months. Okay, I can live with that, but at least I'm not going to lose everything.
So let's, are we talking about real estate or are we talking about equities?
Yeah, so real estate
both? All right,
is my focus. If you're comfortable talking about real
sure,
estate.
absolutely. So there's a lot to unpack in that. Let's do that. And I can't remember whose quote I'm stealing, but I love the line.
I hope it's mine.
Market crashes are where capital gets returned to its rightful owners.
That's
right. I love that line.
That's a good
one. And it totally applies to leverage and real estate. So I'm trying not to constantly reference the book, but there are two chapters in the book that are.
Just remind me the name of the book.
So the name of the book is How Not to Invest, the ideas, numbers, and behaviors that destroy wealth and how to avoid them.
Okay.
So one of the examples I talk about Sam Zell, legendary real estate investor. I had a buddy who was a bond manager at Fidelity. When Zell would show up, the conference room would be filled, the overflow auditorium would be filled. Everybody wants to hear Sam Zell's prognostications. And it turns out that Zell is a pretty crappy economic forecaster. Wait, this guy is a billionaire real estate investor. Doesn't he know about the economy? And if you're objectively look at how he made his money, Zell bought really outstanding properties at distressed fire sale prices and then held on to them for decades. He used leverage intelligently. He was never out over his skis. I hope everybody understands that reference. He never was excessively leveraged. He always was very savvy in how he constructed his investments. Literally, there are properties he held for half a century. So he was long-term. He used modest amounts of leverage, and he bought great properties at even better prices. So if you imitate Sam Zell, you'll be fine. On the other hand, we've seen a ton of people in the financial crisis on the residential side showed us that I love the scene in the movie The Big Short where Steve Carell is talking to the stripper, and he's explaining 228 variable mortgages and what happens when rates go up. And he says you can lose your house if you put nothing down and you're doing this. She goes, house, I own 6 houses. And he immediately, she technically didn't own those houses. My bank credit buddy, Josh Rosner, used to call that, these were people who were renters with an option to default. And that's literally what happened. So the Sam Zell story, if you have a little bit of leverage, hey, listen, a lot of those models that were used on Wall Street assume that real estate never went down. We know real estate went down in the late 80s, early 90s. If you were right in Manhattan, you bought 88, 89. That was peak real estate. Then rates came down, and it took about 10 years to get back to break even.
Exactly.
Obviously, during the Great Depression, real estate prices crashed in some areas 80, 90%. So just a really weird, silly model assumption. The other thing that's kind of an interesting example about real estate is, Robert Kiyosaki wrote Rich Dad, Poor Dad, arguably the best-selling financial book in history, something like 30 plus million copies. Here's a guy who's been forecasting a crash, forecasting a stock market crash, a bond crash, 2018, sell residential real estate, sell commercial real estate. You want to exit U.S. real estate as soon as possible. And I'm hard pressed to find a better time to buy U.S. real estate other than the depths of the financial crisis in modern history, certainly in this millennium. Since then 2018, everything has since doubled and then some from then.
I see.
So there are two charts in the book that show there's always a reason to sell, and it applies to stocks. It equally applies to real estate. Every year there's something terrible happening, and every year things are fine. I mean, we're a little spoiled. We've had so few recessions in the past 25 years, and we're probably overdue for a healthy recession at some time in the future. And yet this economy seems to be doing so well. There's so much cash sloshing through the system. There aren't enough homes. Commercial real estate is different because are we talking about office space, and then there's A and super A versus everybody else. Medical and biotech is a growing area. Warehousing, obviously AI and data centers. So commercial real estate, what part of the country, what sector? Really, multifamily has done okay. Office space is still fairly cheap. Europe has had a much higher return to office success rate than we have in the United States. And so there are a lot of questions there. But the big question to me is anytime, and my frame of reference is equity more than real estate, but anytime someone says, I'm moving to cash, I'm getting out, the three questions that always come up is, okay, A, what's your specific set of indicators that's going to allow you to get in?
Right.
B, if you wait for the dust to clear, you're too late. The market's already sussed that out and ran up. And then lastly, and perhaps most importantly, do you have the temperament, the discipline, the ability to get back in when every instinct in your body is telling you run away? So that's the challenge, especially like being a buyer in March 2009 was really, really hard. We evolved as social cooperative primates. And when everybody else in the troop of chimpanzees in the trees are running away to stay and say, no, I don't think that's a leopard. I want to stay here because everything is there. Bananas here. Every piece of your wetware, your instinct, your evolutionary adaptive subroutines is to join the group and run away.
How often have you not predicted, but even talked about a worst case scenario as being a Great Depression? Seriously.
Very rarely. I will tell you a piece.
Which begs this question. Isn't this time different?
Four most expensive words in finance, according to Julian Robertson.
Different kind of this time is different.
So with equities, my answer is going to be a little different with equities than with real estate because we all know leverage kills. With equities, the other chapter in the book is the CEO and founder of Peloton, right? So here's a perfect example of leverage killing. So here's a guy, he buys like a $40 million house in East Hampton, some crazy number. He's living large. And then during the end of the pandemic, suddenly he's forced to sell that house. He's forced to sell another thing. I've never seen his portfolio, so I don't know what the hell is going on. But it turns out that he was with one of the big brokerage firms that loves to do stock loans. You want to buy a house? You have a $10 million portfolio. Here's $5 million. The problem is if the market takes a hit, we know it's going to come back, but we need the cash for this loan right now because your security is no longer there. So leverage is really, really dangerous. And the rules historically, if you want to borrow against your stock to buy more stock, it's very limited. I want to say it's about a 50% loan to value ratio is all you're allowed. So if the market gets cut in half, you're going to get a margin call. But for the most part, you're okay. Specific stock, really bad because they run up and run down. I'm betting this CEO leveraged a bunch of his Peloton stock, and then the stock came in, and suddenly he's selling his apartment in the city, his house in the Hamptons. Just no, they did not do him a service lending him all that money. But the discipline part is really hard. When markets are rallying, be it real estate or equity, and you're offered a lot of capital very inexpensively. And hey, if my ROI is 8, 10, 12% a year, using my money, imagine if I add a couple of more $1,000,000, I could double that to 15, 20%, which is great right up until the moment where the tide goes out. Right. So what's unprecedented, and Ray Dalio says unprecedented only means it hasn't happened in your lifetime. But we had a pandemic, which was unprecedented, except for the one in 1918. These tariffs are unprecedented, except what we saw with Smoot-Hartley in 1930. And so this range of possible outcomes, the worst case scenario, I included, not because I think it's likely, but for the sake of, hey, I'm not just a, Panglossian sanguine, everything's going to be great. Shit can get really bad if we see more unforced errors and more ill-advised policies from the White House. The 90-day tariff pause, none of us really know what happened, but I like to imagine Scott Bessent, a Wall Street guy, running into the Oval and saying to the president, you better do something or you're going to be Hoover too. You better figure something out because Wall Street is about to show you who's in charge.
Right.
And I did a post recently. The market is undefeated, talking about we had Ben Bernanke in October 2008 asked for authority and money. Rand Paul gave a fiery speech. They didn't give it to him. Market sells off 10% in a week. Here's whatever you want. Just make the pain stop. We saw the same thing in 2020, first quarter. Congress was debating renaming a library in D.C. Talk about meaningless. And they couldn't agree on it. And then the NBA shut down. Everything went south quickly. And suddenly CARES Act 1, the biggest fiscal stimulus since World War II as a percentage of GDP, gets passed. And then again with the tariffs, markets, April 2nd, April 3rd, down 5%, down 5%, down 5%, like 3 or 4 days in a row. Bessent runs into the White House and basically 90-day pause. And as we've seen, the taco trade has been pretty successful. It's not that the markets are ignoring the tariffs. The markets think, yeah, he's not going to, the odds are 3 out of 4, we're not going to see big tariffs that cause a recession or really hurt our future prospects.
Barry, I saw you glancing to one side. How are we doing for time?
I'm fine. I just kind of side-eye Bloomberg on the TV.
Right.
Oh, look, the Nasdaq's up 0.28 and the Dow is flat and the S&P is up 0.25%. Right. Old trade habits die hard. I have a perpetual investment horizon, but I can't help but, what always cracks me up is a market that gaps open high and then sells off. That's always a pretty substantial warning size, or the reverse, gaps down and then ends up positive. Those sort of intraday reversals are worth paying attention to. And if we're open a couple of hours, the market gap is sold off a little bit, but still in the green. I can't help but notice that crap.
I wanted to be sure you weren't looking at the,
I'm good. You got me for another hour till noon.
All right, we won't go quite that long, but let's chat a little bit more. So again, just getting back to this idea of a rarely stated worst case scenario in your career being the possibility of a depression, right? Worst case scenario.
Right.
And reading into what you're saying, does this, based on what you've said, does this require the assumption that that it won't happen, that there will be no more unforced errors? Do we have to assume that Trump won't make any more unforced errors?
I'm going to assume we're going to just have an endless run of unforced errors. That's just, hey, you don't have to be a student of politics to say that's on brand. Unforced errors is very much on brand. But that said, it's the breadth and depth of the unforced errors and how much they affect the overall economy, the market, etc. Did the same exact thing.
That's right. Got it this time.
It really has a pretty significant impact on the markets. Had a significant impact on how far afield this White House has been willing to go. I kind of feel like they've chilled out a little bit, if I can say that.
Really? You've
And
been watching the news this weekend about Los Angeles and
yeah,
troops
so
on the
Los
street. That's
Angeles is
chilling
not.
out, is it?
Remind me, what are the LA, the nonsense out there? What's that going to do to corporate profits? Not a lot. Although I will say to you,
Unless it spreads across the country and
well,
becomes
I expect it to spread across the country, but even still, I don't see this as the sort of 150% tariffs that we've been looking at as the March, April scare. That said, it seems to me sort of an asymmetrical risk to take one bullet, put it in a 6-shooter, spin the wheel and put it up against your head with a $28 trillion economy. Yeah, there are legitimate problems. China's a bad actor. They steal intellectual property. It's not a level playing field. There are lots of other things wrong. But this degree of recklessness with a $28 trillion economy that has enjoyed the single greatest economic growth and wealth creation since the end of World War II, that just seems ill-advised. Yes, I know that there is wealth inequality, and I know that there are other problems in the country, and the wealth that's accrued to the top 10%, 1%, 0.01% hasn't trickled down. But even still, the middle class in the United States is far wealthier than 90+% of the countries around the world. So if you want to deal with problems, well, deal with problems as opposed to engaging in behavior that creates risk, that instead of making things better, you're going to make them either worse or much worse, or worst case scenario, much, much worse economic problem in a century. I still put that at like a 10% chance, a 15% chance. These are made up spitball numbers.
That's okay.
But it's there. I mean, the last time I talked about this wasn't during the Well, I did a piece for Business Week during the pandemic, which said, go big, spend money. We didn't do fiscal stimulus post financial crisis. Whatever we did was insignificant. Go big, do infrastructure. Let's pave some roads and rebuild some airports. By the way, if you haven't flown through LaGuardia, $8 billion later, it's the single best airport in the country. That's a result of people saying, let's spend some money. That actually predated the pandemic. But the idea that, hey, all these other countries like China have industrial policies. They're all spending a ton of money to build research centers and help their educational system and help their higher ed, their colleges. That's where all our growth has come from. If you look at the most robust, economically productive cities in the country, they all have access to human capital and an excellent higher education, college or university nearby. So the sort of things that put that at risk, by the way, this is, public policy administration 101. You don't need a PhD to figure this out. It's a risk factor. So far, there's been some damage done. I'm hoping that most of it is not permanent. And I'm hoping that either the midterm elections or the presidential elections in 28 sort of undo the worst instincts of this administration that has caused that you're keeping really talented overseas students out of the U.S. Let me remind people that half of the C-suite in Silicon Valley, in the unicorns, and in the top companies on NASDAQ were born overseas. Don't we want the best and the brightest from other countries to come here? We've always been a beacon of economic and political freedom. After the January 6th insurrection, I did a post a few months later. What's the rule of law worth to markets? And the too long didn't read is somewhere between 25 and 50 trillion dollars. Why would anyone put that at risk unless they simply don't understand?
Or they have a different plan, right? If there's an entirely different plan. But let's switch to the debt crisis. And
Sure. What debt crisis?
Yes, exactly. So I did make an assumption, but the debt that America has and the impact on the economy of adding to it through what I like to call the triple B tax bill. There's lots of concern being expressed by Larry Fink, Jamie Dimon.
Triple B is a great, big, beautiful bill. Triple B credit rating. I like that.
Jamie Dimon, Ray Dalio, Mohammed El Arian. I mean, the chorus of concern about the impact on the macroeconomic series. All right, so we've got LA and all kinds of shenanigans going on there.
Right. Distractions.
Non-impactful. They are definitely distractions, probably engineered specifically for that as well.
Right.
That's cynical.
By the way, when is Canada becoming the 51st state? When are we taking over Greenland and the Panama Canal? That was last month. We forgot all about it.
That's right. But we've still got another 18 months left, don't we? Or more. I mean, there's plenty of time to make these unforced errors. But in terms of the triple B tax bill and the concerns being expressed by extremely capable, knowledgeable fund managers extensively. What's your view on the potential impact of that if it goes through in its current form?
So I haven't looked at what the current bill is, and I don't because every week it changes and it's a colossal waste of time reading it. But let me just talk really broadly.
Also 1,000 pages long.
Right. I got other stuff to do. But let me talk broadly about debt and deficit. So I finished college in the early 80s, grad school in 89. And for my entire working career, my entire adult career, all I have heard is the outstanding debt and annual deficits are going to be the economic end of America. And here are the problems it's going to cause. It's going to crowd out private capital. It's going to choke off innovation and new company formation. It's going to make it too expensive to finance the debt. It's going to cause inflation or hyperinflation. No one's going to lend money to Uncle Sam. Bond prices are going to become untenable. Cats and dogs living together. It's just going to be mayhem. And it turns out for just about half a century, every one of those predictions have been bullshit. They've been totally, totally wrong. So my rule of thumb is if you suck so bad that everything you told me is going to happen every year for 50 years, you're coming off my list of people I pay attention to. And by the way, let me remind you, the reason the 10-year bond is at 4.5% and mortgages are around 7% today is not because of the debt. It's because the Fed did the fastest hiking cycle, admittedly belatedly. They missed the rise in inflation. They missed the fall in inflation. 500 and something basis points in a year and a half is huge. So rates are where they are because we put them there. When we look at the traditional metric of sovereign debt for a country with its own currency and its own printing press and its own army, we look at what is the debt to GDP ratio. Now you go to Japan,
125. Isn't it, or something
so it's 125 here. Japan is coming up on 250, 300, yes. Right? Yeah. And what are sovereign bonds in Japan? Half of 50 basis points, 0.5%. The reason our debt is high has nothing to do with the deficit. By the way, I'm all in favor of fiscal discipline. I'm all in favor of tax cuts, preferably for the middle class, because I grew up a middle class kid. I got a bunch of really nice cars in the garage that the Tax Cuts and Job Act paid for with their pass-through rates and all this other. Wait, you're going to make me give up a 10,000 SALT deduction and I don't have to, my state taxes in a high tax state come out pre-federal tax. That's a couple of nice cars a year. So I'm talking against my book, but look, if we want to get our fiscal house in order, this Doge stuff is a rounding error. We are an insurance company with a healthcare insurance company with a standing army. That's what the United States is. And if you're not talking about managing Social Security and Medicare, by the way, I could fix Social Security right now. What's the cap? Like 175 a year? Like Bill Gates is done paying Social Security at 12:01 a.m. on January 1st, right? Because if you just break out his earnings. So you want him at Social Security to be stable? Great. And again, I'm talking against my book. Take that 175 or 180, it goes up every year. Raise it to 500 or $1 million. Social Security good forever. Probably goes a long way to helping Medicaid. I don't understand why the United States spends 3, 4, 5 times the amount of other countries on healthcare and has worse outcomes.
Yeah.
So this could be fixed if we want to fix it. The problem is there are way too many rentiers and middlemen with their hands out, catching some of the spend on healthcare. Other countries have figured it out. Just as other countries, we haven't raised the tax on gas since 1991. You want to know why most of the roads in America look like shit? It's because of people who say, no, a tax increase is regressive. Hey, I got to drive places. It'd be nice if I weren't getting flats and broken axles on the regular. Part of civilization is you have to pay for roads. And it's not just roads. It's why do we have electric cables everywhere? Why don't they bury them underground? Why am I looking at this and having them at risk for vandalism, for hurricanes, for tornadoes, for whatever? Like, there's stuff to do. Let's get busy and stop jerking around with, we're going to kill U.S. aid is 0.001% of the budget. Nobody wants to address that because you have to make hard choices there. It's easier to pretend that around the edges we're going to make a difference, and we're just not.
Why don't people? Why are these hard? I mean, your point is well taken, but why are these hard decisions not made? Is it because they're politically?
Politicians are cowards.
Yeah,
they want a permanent job. If I want my congressman to step up and say, "Here's what we need to do: A, B, C, D, E. This will probably cost me my job, but I don't care. It's the right thing to do for America." Look, incentives matter, and we have a permanent underclass. I thought I shut that off. We have an emergency. Yeah, it was on airplane mode, but I put the Wi-Fi on for a second, and that brought it in.
Politicians, right?
Yeah, we have politicians. We have a permanent underclass of people who do what they have to do to stay in office. We've gerrymandered districts, so it's attracted the most extreme people because it's the primaries that matter, not the general. Citizens United has been a complete disaster that has auctioned off House seats to the highest bidder. I don't know who came up with the idea of congressmen should be like NASCAR drivers. All their sponsors should be on their suit.
That's funny.
But that's where we are.
Right.
And, a democracy doesn't work.
At least then you'd be honest about it, right? Finally.
And you got to put some blame on the Supreme Court, who said money is speech. No, money isn't speech. Money is money. I can't believe the Supreme Court is filled with people who are just so ideological that they can't understand that if you're going to allow the billionaire class to run the country, then it's not a democracy. It's an oligopoly. This is just classic. I love the phrase epistemic trespass. Wait, you guys are experts in judicial constitutional law. You obviously don't know jack shit about behavioral economics, finance, and human nature, because anyone with half a brain can figure out, if we let the wealthiest people buy congressmen, how's that going to work for the bottom? I won't even say 99%, the bottom 90%. How's that going to work for them? But that was a sort of deductive reasoning that never penetrated the hardcore ideologues who kind of have been revealed. The Supreme Court used to be one of the highest rated institutions in the country. One of the few institutions that still has a good rating are the armed forces. The servicemen and women still gets a good rating. The Supreme Court, I don't want to get partisan or political, but they've revealed themselves as political hacks. I'm so thrilled that I don't practice law because I don't know if I could ever go into the Supreme Court and make an argument. I would have to call those guys. I cannot help but call out the bullshit I see. That is my cross to bear. And if I ever had to go into the Supreme Court, I would just have a list of what each of these jerks voted for and said, you're the reason why we don't have good roads. You're the reason why we have subprime disasters. You're the reason why healthcare is so terrible in the United States. You're the reason why America lags in all these areas. Your votes have had an impact in various cases. All of you collectively suck. Individually, you're terrible. So you could see why continuing legal practice just wasn't in the future.
It wasn't
going to happen.
All right, Barry, I truly would love to continue talking to you for a lot longer. And I do have lots of questions. I'm interested in your work at Bloomberg, and you do some really cool stuff, actually.
Fun. The podcast has been really fun getting to sit down with people where I shut up and let them speak. It's weird being on this side of the microphone.
Well, the nice thing about that, I mean, look, I, as you know, obviously run a podcast, and I have a very illustrious guest today. Thank you for joining me. But the idea of being able to call and say I'm running a Bloomberg podcast and really getting some of these extraordinary people to join you, I mean, I do reach out to folk like you interview on Bloomberg, and sometimes they respond positively. But it's, 1 in 10. I would love
I'll tell you a quick funny story. First, Bloomberg is recruiting me in 2013. I'm writing for the Washington Post as my side hustle. And I get a tour of the facility, and, the Bloomberg building is amazing. I haven't been to the one in London. I heard that one's even cooler. And I get a tour, and here's the TV studios. I'm like, would you like a television show? I'm like, not really. I don't have enough to say every day. And honestly, there isn't enough to say every day. It's mostly ephemeral filler. Well, what do you want to do? I said, I want to sit down with intelligent, accomplished people and have long form adult conversations. What do you mean long form? Like 10 minutes, 15 minutes? No, like 2 hours. And so when everybody finished laughing, they said, tell you what, if you give us 32 quality minutes, 32 plus traffic, news, sports, weather, commercials is an hour of radio. We'll throw the rest of it up online. No one's going to talk to you for 2 hours or an hour and a half even. And so the first year was me just begging friends. The first one was Jeff Gunlock, who I had kind of met before he got fired from.
Okay, you drop a lot of names. So just in parentheses, every time you say that,
the new bond king, the founder of Double Line, a bond-focused fund, fastest growing firm to $100 billion in Wall Street history. But like I kind of knew all these people before they were famous. So Dave Rosenberg and Rich Bernstein from Merrill Lynch, economist and market strategist. David Kotak from Cumberland Advisors, and just like my Dave Nottig, who is probably the most knowledgeable guy about ETFs in the world. Like all these people I knew came on the show as what's a podcast? What are you talking about? So they came on the show as a favor. Eventually, people like Bill Gross of PIMCO and Cliff Asness of AQR came on. But the first year was me just begging people to come on. So whenever someone has a good podcast that asks me to come on, like, hey, I got to pay it forward. I had enough people do favors for me back in the day when no one really knew what the hell a podcast was. Yeah. So happy to be here. Thrilled to.
I'm delighted you are. I was very flattered when you said yes, by the way. So
if you're familiar with my first year, by the way, the first year is wholly unlistenable. It's just awful.
That's so funny.
But it's just reps. You do 550 of them. You suck a lot less.
It's funny because I actually started podcasting also about 10 years ago. And what triggered it for me was getting a PhD. I had terrible imposter syndrome. And when I got a PhD, I thought, I'm the only guy in my industry that has a PhD. I'm a doctor. Trust me, I'm a doctor. So I started calling all these professors. And of course, they said yes. And I spent hours editing the sound. I got Audacity, which is a sound modification thing. And I spent hours trying to tweak the sound and make it absolutely perfect, and did research and everything.
You ever used Descript?
Oh yes, actually, one of my guys has suggested that I use.
Yeah, it's kind of fun. You edit it by text and it automatically does the audio. I'll tell you something funny about imposter syndrome.
Yeah,
very early in my career, I figured out the William Goldman quote: "Nobody knows anything." There's a chapter in the book about the reviews on the Beatles are hilariously terrible. When they were on Ed Sullivan's show in 1964. I just watched the Led Zeppelin documentary, which was some of the reviews in Rolling Stone and elsewhere about their first album are just laughable, And
laughable in what way? In what way? That they pandered, or that they were just badly written?
No. They were like, this is Jimmy Page is a mediocre guitarist. John Bonham doesn't know what he's doing on the drums. Robert Plant can't sing. These songs are
Okay,
tedious.
right,
The guitar
okay.
work is amateurish. Just
Right.
like, and the same thing were about the Beatles on Ed Sullivan. Look, you don't have to like that Beatles music, but to say they don't really understand melody or harmony, that has not held up well. So what has prevented me from suffering from imposter syndrome
Ah,
was an early recognition that nobody really knows anything. They're all faking it till they make it.
yeah.
And I don't remember if it was Plato or Aristotle who said, the one thing is I know is how little I know. That's a superpower, recognizing I have all these blind spots, I have all these weaknesses, but I'm aware of them. The folks pretending they don't have these, and to bring it full circle, those are the guys who think that we could leverage up on real estate by as much as we want because lower left to upper right, that's all that's going to happen for the rest of eternity.
Right.
Those are the guys who don't know what they don't know. But let me tell you, I love the kids' expression, FAFO, fuck around and find out. And that's what's going to happen to everybody highly leveraged and out over their skis. It's true for equities. It's especially true for real estate.
Yeah. Okay. So you wound down a little bit then, kind of segued me into my sign-off questions, but I was actually
Go ahead.
going to continue chatting, but that's fine.
I got a noon, so let's do your sign-off questions.
All right. So, right, 3 sign-off questions. What are the 2 or 3 market signals that you watch that give you early warning shifts of any kind of major changes? I mean, again, just kind of leaning into this idea that
Sure.
15% chance of a depression. What do you want?
So a lot of people look at sentiment data. I find sentiment data is not useful unless it's at a real extreme. And right now we're somewhere in the middle. Sentiment data has kind of gotten damaged because post-pandemic, Michigan consumer sentiment data worse than the great financial crisis, then 2000, then 2020. So you got to throw that stuff out the window. I like to use a moving average, 3-month moving average of non-farm payrolls. 98% of the time it's a trend and it's very noisy, so you don't care. But you have a moving average and you start to get that rounded top and it starts heading down. That's a pretty good coincidental indicator that the economy is softening. Certainly, you have to be a little careful. I'm looking at the market. You have to be a little careful on relying on the stock market because the old joke is the stock market has forecast 9 of the past 4 recessions, so it's not really reliable. I do look at earnings, and I want to see the overall earning trend up 2-3% a year. Sometimes you have a little dip, but when you start again, that rounded top in stock market earnings is certainly interesting. And I've been watching residential real estate again because we've gone through this crazy pandemic era issue where not only did we not build enough residential real estate following the financial crisis, all the builders pivoted to multifamily, but anybody of means could buy a second home or a co-primary home so they could get out of the city and not have to deal with a lot of other sick people. We're starting to see supply come back on the market in selected areas. So I'm kind of watching that sort of as a gauge of that overall health of the economy and just what's happening in an important sector of the economy. I would tell you the moving average of non-farm payroll and what's going on with real estate supply are 2 really interesting ones.
Second question, sign-off question.
Oh, by the way, and the dollar. I'm watching the dollar, which has tumbled pretty substantially from all-time highs.
Right.
And if that continues, that's going to be a big red flag.
Okay. Right. So somebody coming into $1 million that is meaningful for them, right? So by inheritance, they win the lottery. It doesn't really matter what, but they come into $1 million today. What would you be advising them to do with that money and, over the next 12 months or so?
So the first question is, what are your goals? What do you want to use this money for? Is it retirement, buy a house, pay for your kids' college, whatever? We're big fans of maximizing tax advantaged accounts. So the assumption is they've already maxed out their IRA, their 529, or their 401k, 403b. You look at the rest of their portfolio, you figure out what are they missing. I'm a big believer that the core of your portfolio should be low cost indexes. I don't care if it's VTI from Vanguard or I'm forgetting this symbol of the BlackRock one. You can't obtain alpha if you're not at least starting with beta. So we very often see people, accounts come into the office with 24 mutual funds and a bunch of privates, and they're just all over the place. Keep it simple, keep it focused. That's typically the best advice I could give people. Make sure you're at least getting what the market is giving you. Obviously, risk tolerance, age, goals all affect that dramatically.
Not cash.
No, listen, I always laugh. So I'm gonna digress a little bit, talk about inflation. Sure. There are all these inflationary memes pushed by gold bugs and crypto bros and all that stuff. And they're so much bullshit. They're so deceptive. They're bordering on propaganda. My favorite one, remember the movie Home Alone?
Sure.
So little Kevin McAllister gets left alone during Christmas. He needs some food. He has to go to the supermarket and buy some stuff. And he buys, I want to say it's like $19 worth of food. And the meme, I think the movie was 1990. The meme that goes around every year around Christmas is, look, in the 35 years since Home Alone came out, the bag of groceries that Kevin bought was $19. Now it's $72. And let me call out how much bullshit is in that sentence 3 ways. So first, I don't know about you. I go to the supermarket occasionally. And when I go to the supermarket, I buy groceries with $20, $25. I don't have an envelope with money from 1990. Let me put this aside in case I'm going grocery shopping in 3.5 decades. So that's bullshit number one. Bullshit number two is simply, okay, so here's how much the price of this bag of groceries have gone up, but are you familiar with double entry accounting? That's the liability. What's the asset? And the asset is your income. How have U.S. incomes changed since 1990? And as it turns out, according to 8 different inflation calculators, it's gone up more than the cost of those goods have gone up. So actually, that $72 bag of groceries in 2025 is cheaper than the $19 bag of groceries Kevin bought in 1990. And by the way, this isn't like, I'm not out on a limb here. This is just fundamental mathematics that if you paid attention in 9th grade, you should be able to do this math. And then lastly, money is not a cash. US dollars are not a store of value. They are a medium of exchange. And you should be using this money to buy goods and services, pay your rent or mortgage, maybe some entertainment, vacation, Netflix, whatever, going out to dinner. And whatever is left over, you invest in yourself, in your business, in the real estate market, in the stock market. If you would have put those $20 in the stock market, well, 35 years later, it's worth almost $300. So you buy the $72 bag of groceries in 2025, and you have $230 left over. Please stop the bullshit. The dollar has lost 95% of its value over the past century. If your grandfather buried mason jars full of dollars, then it's not the dollar's fault. Your grandfather was a fucking idiot. Blame him. You can see I'm still kind of on the fence with this.
Exactly. That's right.
Makes me nuts. This is one of those things that so obvious to explain the underlying math. So I don't know if these people are liars, idiots, propagandists, or as we started, selling something. I don't care what it is, some crypto scheme, some other commodity, some trading product. The dollar has lost its value. Who holds on to a dollar for 35 years or a century. It's just nonsense. That makes me nuts.
All right. What political or market developments are you tracking that could cause you to rethink your assumptions about where the market's going? You kind of touched on this a little.
So we had a collective failure of imagination that, despite calling himself tariff man, tariff's the most beautiful word in the dictionary, despite all the stuff we saw in the first term with tariffs, we all couldn't believe that anyone would put Pax Americana at risk. And so the April 2nd, Liberation Day, the reason it led to a sell-off was the Wall Street's collective wisdom was, why would we shoot ourselves in the foot? Like, do you not realize how good we've gotten it? So that's where it all starts and ends. Depending on how radical, like, I think firing Jerome Powell is off the table. I think Wall Street has put a little bit of fear of God into the president. Again, I'll send you to the stock market is undefeated. James Carville might have been right in the 1990s that he wants to be reincarnated as the bond market. I want to be reincarnated as the stock market because the stock market is undefeated. You're going to roll out a half-assed, poorly thought out policy that just was implemented by dropping it on the market. Hold my beer, says the stock market. Let me show you who's really in charge. And so I'm watching. I will say that there is a rising, I don't even want to say probability, an increasing possibility of an unforced policy error. We saw it in March and April. Here it is June. I don't know if this White House economic team has learned the lesson. I'm pretty confident Scott Bessent knows which end is up. And his name was recently floated as replacing Jerome Powell when Powell's second term ends. I'm okay with that. Like most of the Trump appointees, look no further than RFK Jr. and his, I'll make some friends amongst your readers, his asinine anti-science, anti-vax nonsense. Look, there are legitimate health issues that we can address. The measles vaccine is not one of them. It saved tens of millions of kids' lives. Stop making there's so many problems to fix. You don't have to create new ones. And so I'm okay with Bessent as head of the Fed, and the unforced policy errors are what really are keeping my attention.
Barry Ritholtz. Now, I wasn't going to say this. Bloomberg, or the Masters of Business host on Bloomberg.
Yes.
That's the addition. But then I was going to say Chairman CIO Ritholtz Wealth Management. What an enormous pleasure meeting you. And thank you for joining me.
And all this nonsense you're hearing from me, I just want to say, can be found in this book. My last book was 15 years ago, and I had accumulated enough ideas, enough thoughts that all this stuff you're hearing from me is fresh in my mind, because a lot of these are really short chapters in the book. I hate to be such a promotional salesman.
No, it's really interesting. Who's the publisher? Is it
Harriman House in London? They were great. I really enjoyed working with them.
Nice. All right. Well, Barry, really, thanks for joining me. I really appreciate it.
My pleasure. Thanks so much for having me and tolerating all my nonsense.
Okay, that was Barry Ritholtz, who is chairman and CIO of Ritholtz Wealth Management, and also host of Masters in Business, a Bloomberg podcast. How interesting that is. Barry, thank you so very much for joining me. It was an enormous pleasure meeting you and to talk with you. I would have enjoyed continuing our conversation and perhaps diving into some other topics, perhaps a little bit more philosophical. I have a sense that you might have probably quite a deep thinker and would enjoy that kind of conversation, but perhaps that's something we can save for another time. Either way, thank you for joining me. And thank you, dear viewers and listeners, also for joining us today. I hope you enjoyed the conversation as much as I did, got as much out of it as I did. And I have to say it, if you've not already done so, go ahead and subscribe to my newsletter that covers these podcasts in detail, in written form, of course, so you can get a written summary, and comes out whenever I produce the podcast, So about once a week, sometimes twice a week. You can always unsubscribe, all there at gowercrowd.com. Okay, that is it for today's episode. Thank you again for joining me. Until next time, this is Adam Gower signing off.